was asking where the information was on Chapter 11.
Yeah.
Why were there no questions from Chapter 11? We didn't do Chapter 11. But I was glad somebody noticed. That was good. What about 12? 12's a biggie, folks. You can now compute a weighted average cost of capital, true? You can compute the component cost with the exception of the yield to maturity, which I will give you. Make sure you use KI. Almost all of you tried to KD me the other night, I remember. You know, when we were looking at the, the weighted average cost of capital, you wanted to put in the pre-tax, KD, the required rate of return on the part of investors, as opposed to KI, which is the cost of debt. Remember, is KD times 1 minus the tax rate. That's what goes into the weighted average cost of capital equation, as you found out the other night. If you look at your notes, you'll see that. And understand, two things can cause required rates of return on the part of investors and costs of capital to be different. Taxation is one of them. Bonds have an innate tax advantage because interest is deductible. The other thing is flotation costs. Okay, we know that we ultimately will have to sell new shares of common stock if we continue to expand. Merrill Lynch will not do that for nothing. So, in one case of the cost of debt, the actual cost of debt is lower than what investors require to hold my securities. In the case of common stock, the cost of common stock, external equity, if you will, is higher than what my investors require because I have to pay Merrill Lynch. Okay? You know how to do the weighting? Can you do a marginal cost of capital schedule? I hope so. The steps, you'd be able to do that. Of course, the break point, I'll tell you what, I give you guys credit again. I've done this several times this semester. The break points appeared to give you guys less difficulty than they have previously. And that's great because those break points, for whatever reason, drive people nuts. And I'll tell you why. They look at that horizontal axis, and you know, I put dollars raised up there. I even sometimes say this would be equivalent to your capital budget. You know what? This is what you're trying to raise money to do projects. Trying to emphasize the fact that along that horizontal axis, it is the total amount of money raised, and it's raised in the proportions that this organization believes to be its optimal capital structure. You know, 50% debt, 40% equity, 10% preferred, or whatever it is. So every dollar that we raise does not chew up an entire dollar's worth of debt, right? It chews up, in our example, either 40 or 50% of it, and that's the kicker. You can raise a whole lot more money than you have debt available before you run out of it, and that's the key. You guys picked that up more quickly than most. We'll see if that carries over to Wednesday. And I know this is going to be tough for you guys because everybody's going to be celebrating in 215 what the Fed does, and I understand that. You're going to be giddy with excitement having seen that report right before the exam. I'll tell you what, this is about as transparent. Everybody knows what they're going to do, and everybody knows they're holding off until after Tuesday, you know, so they don't influence anything. They've all shut up. Have you noticed the Fed presidents that have been running around the country making statements? They're not talking this week. It's classic Fed reaction ahead of an election. And rightfully so. You know, you don't want to be, the Fed does not want to be seen as influencing anything, or they will lose their independence and will be in trouble. What else in 12, if anything? Let me ask you something. There is probably something on one of these exams or something in the takeaways. And I mentioned to you at the beginning of class last Wednesday that the weighted average cost of capital may be the most important number in finance. Anybody know why? And since it is so important, what do we really want to do with the weighted average cost of capital to be beneficial? I mean, if I'm a CFO and I'm doing my job, what have I done to the weighted average cost of capital? I've rearranged my capital structure so the weighted average cost of capital is what?
Low.
Not just low, but
minimized.
Okay? Do you know why it is so important for CFOs and other people to at least attempt to minimize the weighted average cost of capital?
Get a higher marginal
more gut level reason. As a matter of fact, we probably talked about it the first hour of this class.
Maximize the shareholder.
25th of August, yeah. The only way, folks, that you can maximize the value of a firm is if you have minimized the weighted average cost of capital. And you now understand why. Let me ask you the question one more time. How do we value things in finance?
Present value.
Present value of future cash flows. If I'm looking at the value of an entire company, what do you suppose the discount rate would be that would be appropriate to value an entire company? Wouldn't it be the weighted average cost of capital? Doesn't that take into consideration every single aspect of the firm? I can only raise capital in the debt markets, equity markets, or preferred markets. The market will tell me how risky they think I am. The market will tell me everything about myself by adjusting the prices of those three securities and therefore the rates of return. If I minimize the weighted average cost of capital, that is the discount rate that I would use to value the entire firm based on the cash flows it's going to generate. So given a certain set of cash flows, the only way I can maximize the value of the firm is if I have minimized the weighted average cost of capital. It is a huge, huge number and a huge, huge concept. Okay? Big, big deal. Big deal. So the minimization of the weighted average cost of capital corresponds to the maximization of shareholder wealth. You will see that again when we get into the chapters on capital structure. Because again, remember, the CFO is going to try and change the capital structure of the firm, that mix of debt, equity, and preferred, so that the weighted average cost of capital is indeed minimized. That's the whole idea. That's the reason we worry so much about how we slice and dice the right-hand side of our balance sheet. Okay? And we'll talk about that some more later on. But remember how we value things. If you're going to value an entire firm, the weighted average cost of capital is the discount rate that you would use. So anything I can do to get that thing lower and lower and lower and lower and lower, ceteris paribus, raises the value of the firm. Again, we'll see that in spades when we get into what we're going to do next week. Not next week, but a week from next week. Anything else